All right, guys, this is being recorded, and this is the first webinar in a series of volatility strategies. We're going to talk about, because I'm so annoyed with mainstream media and everybody else, when they're talking about options, you know, they want to talk about the cool option thing, but they just don't talk about it properly. And one of the biggest things to know and understand is volatility. So I'm going to build this series out so that you guys know what you're looking at what strategy you should implement when there's low volatility, and what strategies you should implement when there's high volatility or medium volatility for that matter. We do have strategies for those specific areas. It's not all about buying calls and buying puts all of the time. Yes, there is the time and place. Right now, we're going to be looking for low volatility strategies when we're doing a long call, for instance. But let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as a Wolfman from CNBC, Fox Business, or even the Wall Street Journal for commentary on everything from economic to geopolitical and market analysis. I started trading in college, and with a psychology degree, decided to switch it over to finance. And then after graduating with a finance degree, moved up to Chicago and walked around with my piece of paper, not even a resume, trying to get a job on the floor of the Board of Trade. I got that and sold all my stocks, jumped in the pits, and started trading. So I've been trading my own money ever since. Got to go over this disclaimer really quick. It says any opinions, news, research, and analysis or other information contained here is to be provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies for that matter. The reason why I can't do that is because I don't know your risk parameters, you guys, and I don't know what's in your portfolio. So if I'm talking about a particular strategy around a particular underlying, it's only because it fits the rules, and it doesn't necessarily mean you should run out there and implement it in your portfolio immediately. Make sure it is appropriate. All right. And please remember, the past performance of any trading system or methodology is not necessarily indicative of future results. See, I've said that so many times I've got to memorize. Anyway, you can follow me on Twitter at Wolfman's blog, or our parent company at ProTraderStrat for different market wisdoms. I also, with Twitter, I try and throw out the trades that I've done in the afternoon on Twitter. I usually talk about the trades I'm doing in the morning on the daily market commentaries. So if you're not privy to those, make sure you check those out too. All right, let me go over a couple of real basic things about options just to go over so we're all clear of concept. This is a basic strategy, so I want to make sure that everybody is clear. Delta, it affects the options premium in relation to the underlying for the first dollar move. It's pretty simple, you guys. Delta tells us the first move. So, for instance, these October, we got to find our delta, theta, and gamma. On these options, you can look over here under delta and see these numbers. So what this number tells you, it tells you a lot of different things, but one of the things it tells you immediately is that during the next 36 days, the probability of this option, this 46 option being in the money is 41%. There's only a 41% probability of it being in the money at expiration. It also tells you that for every dollar move higher from 43.62 to 44.62, this premium is going to increase by 41 cents. So it's going to go from 41.03 to, $2.01 to $2.42 in a sense. Okay. So you get that. It increases by 41 cents for every dollar move. Now, gamma, on the other hand, it tells us what let me see if I can get it to switch that way. No. Gamma tells us what the rate of change to delta is, and really it's on that second dollar move, okay? So when we're talking about gamma, the easiest way to think about it is the second dollar move, gamma gets added into the delta, okay? So gamma comes into effect on the second dollar move for gamma, all right? Everybody with me so far? Delta is the first dollar move. You add gamma into delta to figure out how much the second dollar move is going to be affected. And then theta is the impact of time premium. We used to call theta the thief that comes in the middle of the night to steal your premiums. Well, that being said, we want theta and sometimes we don't. Well, with this, we want to minimize theta. So if you go closer to expiration, you can see theta is at 4 cents per day, decreasing these premiums, 4 cents per day. If you go way out here, 64 days, you can see that theta is less on the further duration. It's only going to decay by 3 cents, and even further out, it's going to decay by less than that. It's going to be by 2 cents. So you can see theta, the further out, does not have that really steep decay in the premiums. And finally, Vega, which I think is the most important. This is why I put it at the last, because I think I'm going to be talking about it the most. Vega measures the change in volatility. Yeah, we all care about that. We want to know what volatility happens, but what does that Vega do? So if we go back to this option pricing, you can see the Vega increases by 7 cents. Now that is for a 1% increase in this volatility over here for Micron. So what we can do is look at several different things. Further out, you can see volatility affects further duration more than the near duration, 10 cents to 7 cents, and the closer we get, it's even less, 6 cents. So it goes down the closer you get to expiration. The other thing to note, 3 cents here. What am I looking at? Vega. We're talking about Vega. 7 cents here increase for a 1% increase here. So what happens is we can look at the theoretical and market change. Okay, so let's go up here. I've played around with it before, so let's reset it for today and talk about different things. If we had everything remaining the same, you can see that the theoretical price that you would get to trade would be landing right in the mid-market. Now, there's a couple of things we can do to show our premise on this stuff, all right? So we can look at a $1 increase in the price of the underlying, and what does that do to our pricing model? Well, it goes up from the mark, which is 47 to 402. Well, what's that increase by? It increases by the delta. So if we looked at this delta on, let's just say the 45 calls. 45 calls for the first dollar move should increase by 49 cents. If we go back to that theoretical mark, we can see that it did increase by that pretty close to that 47 cents. It's hitting on the 4 cents, 47 puts us pretty close to that. All right. So that's where delta adds in on that first dollar move. The thing we want to look at now is what we have for volatility. Now watch these prices as volatility increases. So I went back to normal. We're right there at the mid-market. Now as volatility increases, you can see those prices increase. So let's go back to that 1% increase in volatility. So we got the 1% increase in volatility. We add that 7 cents, remember, and it gives us the 313. So if volatility, all else things being equal, just increased by 1%, then we get a 7-cent kicker on us, all right? So volatility, when we buy options, we want it to go up. Because if it goes down, we can see our premiums go down. We don't want to see our premiums go down. So how do we set this up? In a low implied volatility environment, we're looking for low volatility. We also have a directional assumption, but we want low volatility when we're buying options because we want the probabilities of options expanding to be in our favor. We can look at a chart. You can see as volatility expands, that's when we want our rise. So we would want to buy options down here and see that rise in volatility. We could see a directional move against us, but if volatility is in our favor, it will counteract that directional bias, okay? So that's what we want. We want this volatility to expand when we bought options. Add gamma to the delta on the second dollar move. Made that easy, thanks. Good. See, Banu's been with me for quite a while, and she still learned something new from these webinars, even though I bet she's heard the long call before. It's because sometimes I think of things that I may have forgotten. So So we want to get volatility when it's really low. Obviously, this particular underlying is experiencing real high volatility. So we would not want to be buying options up here, right? Because if this happened, even if we were directionally right, we could see ourselves not making money, all right? So we want volatility to expand for us, absolutely. All right? All right, so now that we've gotten that out of the way, let's talk about the long call specifically. With this, we have to be directionally bullish, all right? And you have to be really very bullish, because as that thief in the night, theta, comes and steals our money, we need to have that directional move outpace that theta decay. If we're trading sideways, that's going to hurt. All else things being equal, just theta decay eating away from us, all right? We would definitely want something like volatility to expand. But one of the main essentials to success when you're picking a long call strategy is making sure you have the right environment. And when I talk about environment with just about any strategy for the most part, we're talking about volatility. The volatility in and around this underlying has to be very low for itself. I'm not talking about like, a tech stock having like a 40% volatility versus like a utility having a 10% volatility. Well, that tech stock at a 40% volatility might be really low for itself, because usually it's up around 60. Whereas that utility at a 10 might be really low because it's usually around 15 or 20. Okay, so we have to determine if the environment is appropriate for that underlying. And the way to determine whether it's appropriate or not is through this little chart here, the implied volatility. Is implied volatility for Micron technology at around 60 high? Yes, I can just look at this chart and say it is. But we need to have some math to come up with this. Chuck, I'll do gamma here in just a second. So what we need to do is take where the current IV is. We have a numerator and a denominator. In the numerator, we take one sum and divide it by the sum of the denominator. In the numerator, we have where the current implied volatility is for XYZ, or MU in this case. Implied volatility is currently at 59. Subtract that 59 from the low, which is 36. So in the numerator, we have 23. 23 divided that by 65 minus 23, or 65 minus, 36. So 29. 33 divided by 29, 23 divided by 29, you could say this is upwards of in the 60 percentile at least. Well, you can kind of go here and do the cheat, 78. I did that in my head and was way off. Usually I'm better at that. But you can see IV percent, and we could do it with a chart. So let's just make sure we do this correctly and pull up a calculator. So we got 59. Subtract that from the low, which was 36. Subtract that from 36, and we've got 23. So we take 23 and divide that by the high minus the low. The high was 65. 65 minus 20. 65 minus 35 equals 30. So we do the 23 divided by 30, and we get the 76. That's closer. And again, I was rounding it off. So it's in the 76th percentile. For this particular strategy, the low volatility strategy, we want something that is below 50. And to be quite honest, I like to go with long calls and long puts somewhere below like 30 for stocks. Something definitely below 30 for ETFs. Those probably should be in the teens. But the lower the better. We want the lower the better, because the lower the volatility is, the probability is that it's going to want to revert back to the mean, come back to the middle where it's comfortable, all right, where it's normally at. So we want to buy really low and have it revert back to the mean. That will help us out. All right, so explain the thing about delta and gamma again real quick. Let's back up real quick. Delta and gamma. Delta tells us what it tells us a lot of things, but one of the things delta tells us is the first dollar move in XYZ or MU, this 46 call is going to increase. If this goes from 43.62 to 44.62, this strike is going to increase by 42 cents. So for every dollar increase in the underlying, this strike is going to increase by 42 cents. And this one's going to increase by 47 cents. This one's going to increase by 25 cents for every dollar move. The second dollar move, we take gamma and add it into the delta. And as you can see right here, we add the gamma into the delta. In a sense, we're looking at the delta of the previous strike, right? Because that's the second dollar move. Does that make sense for everybody? So the second dollar move, you add it in because it's going to be right around here. And that one says 52. Does that make sense? So the 37 delta, the second dollar move, you add that in, you kind of get 42. So it self-checks. It's not always exactly that easy to come up with, but you get my idea of the second dollar move. Gamma tells you what it's going to happen. The closer to expiration, gamma starts increasing. Okay, the closer to expiration, gamma increases on these closer to at the monies. All right, so that's the gamma. Volatility, we want really low for this particular underlying. Something below 30 is, the best case scenario for an underlying ETF, something below 15. But my rule of thumb for this is any stock, you want to buy options when they're below 50, sell options when they're above 50, the implied volatility percent. So is the IV percent, do you look for, Trevor, did I answer your question on the IV percent? For this particular underlying, or for this particular strategy, we're looking for IV percent below 50. Best case scenario would be below 30 for any individual underlying. Show how to put that volume chart up that I just showed, the volume profile. If you're talking about the volume profile, I have a webinar, or I have like little videos to show how to do this volume profile, to build it out the way I have. Same as the VIX, the VIX. No, this is not the same as the VIX. What this is, the VIX gives you the overall volatility of the market. So it kind of judges, if the buying of puts and stuff like that starts happening, volatility is increasing because those premiums are increasing. This is talking about where volatility is for this particular underlying in relation to where it's been in the past. So it just gives us a ballpark as to where it's been in the past. So, this is in the 60th percentile or almost the 80th percentile of where it's traded. Therefore, I would expect volatility to come out. And having said that, if I expect volatility to come out when it's really high, plus it's heading into earnings here. When it's really high, I would expect it to come out. When it's really low, I expect it to climb. So that's what we're looking for. It doesn't mean that when it's really low, it can't go even further down. What it means is the probabilities are that it's going to come back. And just like I said, if it's at 100%, doesn't mean the next tick up isn't going to go against you. Yes, it is. It's still at 100% too when it goes continually higher, because that last print is the highest print. Therefore, it's at 100%, right? So it doesn't mean it can't go higher. It just means that the odds are it's going to start, it's just overextended, just like any other chart. You see these charts, they get overextended, they want to come back. When they get overextended to the downside, they want to rally back. That's the same thing as these. We're just trying to figure out when it's too high. That answer your question? All right, so picking the right underlying. This is pretty simple. We pull up the charts, and what we do is we look at the option montage. Anytime I talk about an option montage, it's really this page. It's all these different months and strikes and everything else. So we look at the option montage, and we usually, for this strategy or for figuring this out, go to the closest monthlies, the 6 to 8 days. That usually the monthlies where the spot month is what we used to call it, where most people are trading. And we take the underlying. If it's under $100 like MU is, then we look at the bid offer, and it needs to be at least less than 10 cents wide. If it's over 10 cents wide, I'm going to look at a different stock. I'm not even going to put it over at my watch list. So stock under $100, 10 cents wide. We look at a stock over $100, for instance, Visa, and Visa has a $100 stock. We move the decimal 3 ticks to the left for a stock over $100, and that's how wide the bid ask should be. In this case, 15 cents. Go down and look. Yes, the bid offer in the option montage closest to expiration is 15 cents wide. That's what we're looking for, just out of the monies. The in the monies are going to get a little wanky. Just look at these ones just out of the money to fit this rule. Stock under $100, 10 cents wide, no more than 10 cents wide. A stock over $100, move the decimal 3 ticks to the left. That's how wide this bid offer should be in the option montage. If it is 25 cents or 50 cents wide on a $150 stock, walk away, you guys. You have to give up too much edge to get in and too much edge to get out. And if I had to give up, if this was like 50 cents wide on this, I would have to give up, say, 20, 25 cents to get in. Well, if I give up 25 cents to get in and nothing else happens, I would have to wait almost, 6 days in order to make up that 25 cents because this decays by 6 cents a day. I'd have to have it decay by 6 cents or 6 days in order to get back to scratch, in order for that offer just to be where I want to get out. So make sure you have a tight bid ask, because the more edge you have to give up to get in, the more edge you have to give it up to get out, okay? And it's not worth it, just especially when you're newer to trading, all right? So picking the right underline, picking the right duration. We want slow theta decay, remember, because we're buying this. We don't want that thief to steal. The thief really picks up his stealing coming into these last 35 days. So we want to be outside of this. So more than 45 days. Usually when I say buying options, you stay outside of 45 days because you can see the slower decay of your options. Now, these are the at the money, and we aren't necessarily going to be at the money, but this gives you a great visual representation as to what happens to your options premium the closer we get to expiration. So we want slow theta decay. All options have theta decay, but we want to kind of play out here when we're buying options, okay? And usually when I'm buying options, I'm right around in this area, okay? And hopefully out before I start seeing theta decay. Does that make sense? All right, I think I got everybody up. Oops. So picking the right strikes. With this one, we're going to be picking about a 45 delta. All right, this is usually where I start with buying long calls and puts. I looked at this 45 option. This one obviously doesn't have it, but we're not looking at 35 days. I want to go outside of that 35 days, outside of that 45 days. Somewhere one of these two is where I'm going to be looking. I'll probably look at the NOV. 45 delta. The reason why I look at the 45 delta is, remember, I told you for every dollar increase, delta adds into the premium, right? Well, it also tells you the probability of being in the money at expiration. In the next 64 days, I have a 44% probability of this option, the 150 strike, being in the money. Okay, 44% probability of this option being in the money. 56% probability of it being out of the money. But another thing delta tells you guys, and this is something that we learned on the floor, is a floor trader hack, if you will, is 2 times the delta is the probability that my strike will get kissed or get touched, however you want to say it. The market will come up and trade 150. So Visa has a 88% probability in the next 64 days of trading 150. Okay? 150. That 150 handle shows up. There's an 88% probability of that happening. All right, that's why I want to pick that one. You pick out here on the 15 delta, people buying calls and puts out here. I don't know why. You only have a 30% probability of this ever even happening. All right, 30% probability of 160 trading in the next 64 days. That's still pretty low, right? It's lower than flipping a coin probability. You're better off flipping a coin on this particular one. So pick around the 45 delta. I don't care if you go to the 40 delta or something like that, slightly out of it, but we're going to start out around that 45 delta, all right? Because that is the higher probability of getting in the money. And once we get in the money, then you can see our deltas start jacking up faster, and we're going to be making money faster, which is what we want, all right? How do you get that 80% chance of in the money? It's not 88% chance of being in the money. It's a floor trader hack, and you're not going to find it anywhere else but by listening to me, or maybe if another floor trader tells you this little secret, which they don't usually. But delta one, we said, for the first dollar move, 44 cents goes into here. Second dollar move, we add gamma into it. Delta also tells us that in the next 64 days, this strike has a 44% probability of being out of the money, or sorry, I'm saying that wrong. You guys, it has a 56% probability of being out of the money, only a 44% chance of being in the money. But 2 times the delta is a floor trader hack. 2 times the delta tells you the probability in the next 64 days of these strikes being touched, or just trading 155 even, okay? It's 2 times the delta. So the 155 strike has a 56% probability of trading there, and an 88% probability of trading 150 in the next 64 days. Did that answer that? I'm sorry if I was saying the in the money wrong. This has a 44% probability of being in the money and a 28% probability of being in the money. If I said that wrong, please forgive me. But 2 times the delta is the probability of being kissed within the next so many odd days, okay? All right. And knowing our exit, with our exit, a 50% increase in the premium is where I get out. And the reason why I do that is because the probabilities have been beaten. I've beaten the probabilities in that case. Probability of touching if you want to compare. Lee. See, Thinkorswim's caught on to us and are stealing they're a bunch of ex-floor traders anyway. It's not surprising. So what was my knowing our exit strategy? Why? Apple, perfect example. And if you guys watch the daily market commentaries, I was laughing about this all day because we had really low implied volatility here in Apple. Well, what did I do? I sold calls in Apple. Yes, I'm that guy. I sold calls in Apple when it came up here and started hitting the 161 Fibonacci extension. So I sold some puts in there, sold some calls. Sold some calls in there because I expected the market move to go to the downside. Also, when the market goes down, we get volatility expanding. Well, I got both of those in my favor, and I can't remember what the exact calls were that I sold, the puts I bought were right offhand, but I bought the puts, and I think they were the 120 puts, but I got the directional move. Volatility expanded. What happened? I bought them for like $5.50 is what I bought those puts for. They increased to $8.50, which is over that 50% increase in my premium. I tried to squeeze it. I tried to sell, get out of those for like $9. Market started bouncing back on this day right here on the 7th. It was before we had the rally. It started kind of bouncing. I decided to chase it and got out for $8, slightly less than that 50% increase. But that was the day that it did that move. And that's the key to get out, right? There's no support or anything else around here. Somebody might say that this was a support resistance area. I didn't see it as that. I just saw it as, hey, my premiums are out. The next day we got this blast off. I would have been so ticked off. That just goes to show you we just don't necessarily know the directional move. Well, what have I done since then? Well, when I got that bounce, volatility started coming out. Now I've sold puts against this move. It's just high implied volatility. So you can see on here, I sold those puts right in line with my rules. It was right around the 16 delta. It's gone up and away from that, but you can see that I'm just playing that based on what I see volatility. It had nothing to do with, all these support resistances and everything else. This did. That's what got me into the trade, but not this getting out. That was just a function of me staying mechanical with my trade. Does that make sense for everybody? And then when I saw the volatility coming out, it's the time to sell volatility, and directional move helping me out. As a matter of fact, that trade's been on for one day, and I'm almost at 50% of my max profit on it already. I'm about a nickel away. All right. In the money at expiration, but probability of touching any time prior to expiration. Correct. That is correct, Benu. And we're talking about the 2 times the delta. Delta tells you probability being in the money at expiration. 2 times the probability tells you the probability of you getting kissed during that option expiration. Right? Meaning it comes up and just touches your price. All right. But that's this example, and this is one of those things where I take millions of screenshots, it seems like, and this is one of those ones where I didn't take a screenshot of it, and it perfectly played out. Volatility, expanding directional move, got out 50% increase in my premium on that, and then decided to start selling premium for the other move, volatility coming out. I mean, it's a beautiful thing, right? All right, so finally, also, we need to be conscious of dividends, especially when we're buying calls, you guys, because on the ex-dividend date, that day the shares are expected to drop by the price of the dividend because those purchasers of that stock on the ex-dividend date will not get a dividend. Okay, so they're supposed to be compensated for not receiving that dividend. It doesn't always happen. It is a theoretical thing that it's supposed to drop. It doesn't always. I can show you examples of Apple where they do $1 dividend and they actually increase by $2 on that ex-dividend date. It is just a rule of thumb, but you could be aware of the fact that if my call or the underlying drops by whatever that dividend, that could affect my calls negatively, right? Because I'm bullish. I don't want to see that drop, okay? Another thing is if these calls go into the money and you really love this stock and you're thinking, man, I've done really well with these calls. They're getting ready to go to expiration. Should I roll them? No, you should never roll calls that you are long because you're throwing good money at that. The best thing to do is not even take assignment, you guys. This is a pro tip because the cost of assignment is going to be like $15, all right? Plus the regular commission rates to have that assignment go through. It's better to get out of your long calls for that price, for those commissions, and go out there and just buy the stock for those commissions. Both of those commissions added together is going to be less than the assignment. The assignment fees that you have to go through. So pro tip is get out of your position, and if you really want the stock, to go out there and buy it. All right. How about earnings? If you're talking about earnings, I don't mind putting a long call on headed into earnings as long as you're like 45 plus days out before that earning, because as that next 45 days comes in, you should expect volatility to start expanding heading into that binary event. And a binary event, you guys, is just any event that is going to affect an underlying. So a stock, its binary event is the earnings. It could be its dividend. It could be an earnings call or just some kind of special meeting or something like that. For the bonds or treasuries, Their binary event is an FOMC meeting, you know, when they're changing rates. That's their binary event. That's when they see it. The grains, they just saw it with WASDE report coming out on what the crop report is. So you see volatility expanding heading into that. All right. What about earnings? The Trump tweet? I'm not sure about that one. Interactive Brokers doesn't charge assignment fees. Wow. Good. Because that means everybody else should be following suit. Then in that case, it would be much cheaper. Sorry, probably getting somebody calling me that doesn't know I'm doing a webinar, clearly. All right, so your max profit. Anytime you buy a call, your max profit is unlimited, right? You can go to the moon. This stock could go from $2 to being in Google status overnight. Well, no, it doesn't happen. But just know that when they write this up, your max profit is unlimited. I'm looking for a 50% increase in my premiums. That's where I get out because I've beaten the probabilities. Your max loss is that premium paid. And people say, hey, do you get out for 50% of a decrease in this? Usually I pretty much write it out, but I do a lot of times if it's starting to go against me, if you see it break a Fibonacci support level, I'll pull it out then and say, hey, I'm out of it. I almost pulled the ripcord on my SPY long calls not too long ago because the directional move was not happening quick enough for me. But now we're getting this little bit of bounce, so it's kept me into the game a little bit longer. But I have a friend that actually has a time stop on just about every option trade he has. If it doesn't start happening immediately, then he says, after 5 days, I'm out no matter what. I don't do that. I'm a little bit more flexible. I look for my profit target on long options. I usually am writing those into the sunset. Did you say the 45 delta area is what you're looking for? Yes, I'm looking to buy these options, and I'm going to pull up the trading platform here in a second. But break even is our long option plus the premium paid. So if we buy the 100 delta option and we pay $5, our break even is at $105, right? It's got to get to $105 to get to our break even. Now, that's all other things being equal, right? Obviously, if volatility starts spiking and things of that nature, it could feel like we are further away from our break even than what it looks like. But all else things being equal, at expiration, this is at expiration, the very last day, the break even, if I paid $5 for this and it was settled at $105 on the last trading day of the options, I'd be at break even. All right. Eric, your favorite line in the sand Fibonacci support number? I think it might be. Somebody else was killing me about that. Line in this, I always say line in the sand and at the end of the day. Probably should bury those two statements. Is that 45 deltas in more than 45 days? Banu, that's perfect. 45, 45. Plus 45, plus 45. All right. When do you decide to buy a call or sell a put? Volatility, Gustavo. Volatility determines whether I'm buying the call or selling the put. All right. And 50, 61.8, William, I'm not sure what you're talking about, that fib or 61 fib. Sorry for the question. But what do you mean by that on the fibs? Are these parameters on the long call same as buying the long call or the poor man's covered call? Poor man's covered calls is a little, as I'm not as finicky on my volatility for the poor man's covered call. Oh, my support. I don't have to have any specific support. If you were talking about the Apple trade here, this was the Fibonacci extension. Is this what we were talking about? When price hits the 50 or the 60 fib? Oh, in the ES. Did I have that? So I have the 61 Fibonacci. This is on an extension. This is a Fibonacci extension from this high to this low to create these. Stay with Apple long. Yeah, they're coming out with a new phone. Anytime they come out with a new phone, I think you got to be long Apple. All right, so let's go over a couple of examples. Let's pull up the platform. This is where we're going to be looking at it. You guys can throw out a couple of examples. We're running out of time here because we chatted a lot, but that's fine. So we want low implied volatility. We could look at SPX. Is anybody bullish on SPX? You can see pretty low implied volatility. One thing, the reason why you need to know that fraction, the high, the low, or take where it's currently at, subtract that by the low, divide that by the high minus low, because you get anomalies like this, crazy anomalies. This kind of move and this kind of volatility might not happen for another couple of years. Therefore, you could call it almost like a black swan. It's a very rare occurrence. So in that regard, you can discount this type of spike, okay? And I do that. So you would make this then the high when you're using that. This currently minus the low, take that sum and divide it by this high minus the low, okay? And that will increase your volatility in a sense, because drug stocks do this a lot where they have a trial result and they get a huge spike in it. Okay, so let's look at applied materials, because I like to look at stocks that have, I'm a contrarian. This stock has been beaten up almost all year. Fibonacci extensions didn't even work. I probably could get rid of that. That's not even part of this anymore. But anyway, let's, get all this stuff off. So it looks like to me it made a bit of a bottom. All right. This looks like we've kind of created a bottom. I'm going to look for it to at least come up to maybe this volume node or where it consolidated, just a little bit of a pop. So in that regard, it's under $100, bid ask inside of 10 cents. Yes, that fits the rule. So let's go out here, and I'm looking for some calls that I wanted to trade up above 40 at least. So where's my 45 delta? It's going to be this 40 calls. So that's where I'm looking at. I've got a 90% probability of this happening. If this premium increases from $1.70 to what's a 50% increase of $1.70, that should be right around 90. Let's just call it 80 cents, right? 85 cents. Let's say 85 cents. So 85 cents onto this. So when it's right around $2.30 some odd cents, that's where I'm getting out. And I write this stuff down, you guys. When I'm going through my steps of all of these different things, the essentials to success, I'm writing all this down. What was the environment that I entered it in? What was the volatility, implied volatility percent? The underlying, what was it, the bid ask? What duration did I pick? 35, 45, what was the days? Strike, what strike did I print? And then knowing my exit strategy, write all of that stuff down, you guys. You hear me talking about being mechanical, and that is the way to get ahead in this game. Go through the steps. Low volatility means you're buying this call, all right? Make sure you follow these steps to increase your probabilities of success, and write all of that stuff down, because if it's just in your head, you're willing to bend your rules a little bit more. And if you write it down, you're more likely to stay with it and stay mechanical. That's how you get ahead in this game, you guys. Being consistent, staying mechanical, and when you've written it all down, you can keep track of all your data. All right. All right. Recording, this will be coming out. Chuck is recording. Eric, my typing stinks. Mine does too. So does my reading, William. What want to know about your preferred support fib level for exit of a trade? Example 50 Fibonacci or 60 Fibonacci. William, I usually will kind of enter my trade around like the 61 or the 38 kind of thing. The 50 might be a trade where I put it on as well. Any of those levels, I find support resistance levels, I don't necessarily have to wait for those. If I see it hitting one of those, I know everybody else is kind of jumping on. Some of their early adopters are going for the 50, some are waiting for the 61s, right? So I will look at all of those, not because I necessarily believe in the tea leaves of Fibonacci, but I think that there's so many other people watching it that it comes to fruition in a sense too. So, I mean, I do believe in Fibonacci. You see me using it all the time, but is it because there's that in the galaxy, the spirals and all that stuff. I don't know. All right. Can you set a stop and or profit target using bracket orders? You can set a stop on, an enter and exit on it. But the stop, I always say my stop is this clicker that right here. That's my stop. Every time I hit that thing. Do you introduce some adjustments with the long call? No. The one thing I would do with the long call is if it was going against would maybe sell some calls against it if I had seen volatility spike and saw an opportunity to, cover my loss there. But I'm not going to buy another call, roll a call out in time, or any of that stuff. I'm going to walk away from it. Okay. Does that make sense? All right. I think we have time for one more example. I think somebody was saying that they wanted Texas Instruments. I haven't looked at Texas Instruments in a long time. TXN, Texas Instruments, over $100 stock. Let's look at the strikes here. It is inside of 10 cents wide, so Texas Instrument fits that. We'll go out here in time and see that the further out you go, it might not feel like it's that same 10 cents wide, which it won't be that far out. 120 some odd days. I don't know if I'd want to go out this far, but let's just look at it anyways. The 110 strike, I'll look at this and say, that looks pretty bullish. It's gotten a bounce with a little bit of a confirmation that covered that gap. This could be a continuation pattern to the downside anytime you get those counter-imposing dojis. But I'm going to lean towards it's wanting to go back towards the point of control, which is right around that 110 strike. So that's good for me. All of those things fit my rule, so I'd go in here and buy this. Now 50% increase. I'd get out at $6 when it gets there. Some people can get out when it trades 110. I have no problem with that. If you have a lower risk parameter and you want to say, all right, well, I'm buying these 110 strikes. When it gets to 110, that's where I'm getting out. When I see it just trade there, I'm getting out because I know I've beaten the probabilities. Probabilities are 80% of me getting kissed, but only a 41% probability of me being in the money at expiration. So you've beaten the probabilities by getting kissed, pull the ripcord. Anytime you beat the probabilities, get out. That's the only way to stay in this game is beating the probabilities, and you can increase your probability of success by doing this at the right time with the right environment, all right, with the right underlying. All of those things are increasing your success, right? My question is, how do we monitor what the exit without watching the computer all day? You can't really get out for with this, the beauty in it is you don't have to worry about it going worse than what you already knew when you set up, because our max profit or our max loss is what we paid for it. And then, for instance, with this one, if you bought this strike, you could just put in an offer at $6 and wait for it. Okay? Does that make sense? All right, guys. So I'm talking about my daily market commentaries and stuff like that, which is, I think, as important as any of these webinars, because what I do is I go through my strategies in these webinar or in these daily market commentaries and talk about XYZ as high implied volatility. Therefore, I'm selling premium in it. I go through. So it helps reinforce all my rules on a daily basis. And I show you how I'm staying mechanical. So you get 2 months for the price of one. It's a huge discount. You guys got to take advantage of this. Let me see if I can put this in the chat window for you guys. Oops. Let me see if I can do this again, because I think I put the wrong thing in there. Copy, paste. All right, now it's in there. So there's the link for this. You guys can take advantage of that. 2 months for the price of one. Great deal. You get all my daily market commentary videos. That's where I talk about every single trade I put on, when I take them off. I talk about earnings. I talk about the economic data that comes out, how that's going to affect the markets, what I think that the markets are going to do based on that. I mean, we had a huge drawdown in crude oil yesterday, right? Everybody's thinking crude oil is going up. Well, I dig into those numbers and talk about the distillate builds, which is the stuff that goes into the manufacturing. We're seeing a huge build there. So all they're doing is taking it from one bucket and putting it into a different bucket that nobody looks at behind the screen. All right. Nobody looks at those distillates and gasoline inventories rising. I talk about that. And that is important. You saw what happened in crude oil today. It took a massive tank because people were all of a sudden like, oh my God, there's actually a huge build in all these byproducts. What are we going to do? So I talk about all that stuff in the daily market commentary. So for the price of it alone, I think it's worth that. You also get access to all the trading workshops and the live trading videos and trading lesson video archives. There's short 15-minute videos on some of my or most of my option strategies. So it's like a refresher. You know, one thing I talk about with these, the webinars, watch them right afterwards so it sinks into your long-term memory. If you watch it soon afterwards, now a couple months down the road, you kind of remember it, just want to brush up on the rules real quick. I've got a couple of videos like that that you can take advantage of. And you just click them off. You just click on the box that shows that you've already watched them. And one thing that's not mentioned here is you get free access to me. You get, if you have a problem, you have a question, you can reach out to me. I will get back to you ASAP. I have a no inbox policy, so I make sure I get back to you right away. I know how it is when a trade's going against you or you want to answer to a question. I'm going to get you that answer as fast as I can. If I can't do it in an email, I will call you guys. Also, what was the other thing? You get access to me. I can't think of the other thing right offhand, but anyway, you can call us at 310-598-6677 or trading@protraderstrategies.com to take advantage of that. If you're watching this on tape delay, you're going to have to pause it and punch this into your URL. I also want to thank you guys all for attending this webinar. In later webinars, I'm going to be drilling down on different option components, how I trade, when and where I find those trades appropriate. You can also pause the webinar and click on this. You guys that are attending this, it's over there in the chat window. We've been going back and forth in the questions. There's a little chat window over there. You can click on this. I want to thank you guys all for attending. If you have any questions, contact us at 310-598-6677 or email us at trading@protraderstrategies.com. All right. So you guys, another thing with this strategy, you put this on and it doesn't work out. Know that you know the probabilities were against you to start out. All right. With the 41% probability of success. You know, we have a higher probability of being kissed. Get in and get out of this strategy early. All right. Follow my rules. Make sure you do not buy this strategy in a high implied volatility environment. You could be directionally right and see the premiums come out. Sometimes, you know, you'll see 33 cents a percentage point on this decay. And that's huge. That's going to be more than in some cases, the volatility can supersede what your increase in the premium is. Okay, it's not always the case, but you can see in, let's say, a high implied volatility environment. Let's look at something really high real quick. Let's just look at Tesla, because volatility here you can see is higher. So if volatility goes down by 1%, if I bought this strike, if I bought the 305 strike in Tesla, all right, and volatility goes down by 1% and Tesla goes up by $1 at the same time, I lost money on this strike, on the 305 strike, because I lost 49 cents due to the volatility decreasing and gained 47 cents for the premium increase due to Delta. So don't do this in high implied volatility percent markets, guys. You get what I'm saying here? That's why it's important. It would offset almost, right? Whereas when you get way down here, low vol, you can see the Delta isn't really going to be hurting. Or sorry, the volatility is not going to be as hurting as much if it goes down. That makes sense? Do I trade VXX? No, I don't, Lee. That is one thing I've never traded is VXX or VIX. I don't like the way that those act. I use those. You know, another thing I say also, Lee, is I don't trade the leading indicator. I like to trade the lagging indicator. The stock is the leading indicator. The options lag a little bit. Fed fund futures, they lag the bonds. All right. Trade the lagger. Don't always trade that front runner. So, leaps on diagonal, advice on your trading on leaps on diagonals. I'm going to be doing that one. Poor man's covered call here coming up shortly. I'm not there yet though, but I will be doing that. And if you take advantage of the 2-for-1 premium membership trial, you'll be able to see one of the previous poor man's covered calls that I've done, and synthetic longs and stuff like that too. Poor man's covered put, all of that. But I'm going to be talking about those with specific volatility coefficients around that here coming up too. So keep your eye out for that. It's going to be a little bit different this time. All right. So guys, take advantage of this. Like I said, it's in that chat window. I want to thank you guys all for taking advantage of this. And one of the few things we can do is setting up our strategies at inception the correct way. That is one of the few things we can control in this market, is setting these up for success. And by buying the long call with really low implied volatility is essential to your success in trading options. All right. So if you take nothing away from this webinar, I know you can figure out how to do a long call online. They're not going to tell you the strike location. They're not going to give you what days the expiration you should use. And they're definitely not going to tell you volatility, because most of those guys don't even understand it. I'll even tell you the guys that are some of my good friends, talking heads on CNBC and some other news outlets, don't understand volatility like they should. So anyway, that's all I've got. That's my soapbox. I hope you guys all got something to take away from here. And please take advantage of the premium membership offer. I'm sure you guys will have something to take away. And if you have any questions, please reach out to me. Or if you guys want me to talk about something that I haven't covered, reach out to us. Let us know. Always looking for good feedback and material. All right. That's it. Other than, if you can't take that, take it easy. JQ in the house, all over it. Back to basics. Seems like all this was all before, but always pick up something new. Yeah, see, JQ, another one that was part of this earlier one, but we drilled down on it, and I always try and bring something new to the table for you guys. All right, take care, guys. Anytime, Chuck. Take care, buddy. Ted, you were quiet today. Good to see you, bud.